Hi everyone, welcome to Value. So today we're going to look at a stock called Cango. Current share price $2.36. After hours you can see it's up 19% to $2.81, and the big reason is why it's because they're going to pay out $1 special dividend, which is a heck of a lot of money considering their share price is so low. Which is a massive return. So the big question is, are they just liquidating the company and giving the money back to shareholders? Or is their business been booming that they can afford to do this? We're going to dive into their financials and see what might be the real reasons why. But yeah, $1 when the share price is $2.36, is that just extreme value or not? Current valuation at that $2.36 price tag is $344 million. So overall, the company value is relatively low compared to what we're used to reviewing. But if we look at the 12 months, their share price was at $6.87 12 months ago. Now it's at $2.36. So obviously something has not gone right for the company. But if things aren't going right with the company, how are they able to afford this? So we're going to jump into the announcement. So this is a Chinese company that specializes in car financing, and you can kind of guess, there's a bit of a stigma around those Chinese companies listing in the US and how real their financials can be. So then, we've got a few questions there. And we'll possibly never have the real answers how true financials are entirely. At the end of the day, we can never be that certain for any company in general, and even much less so for companies like that list from China, because we're very well versed with what happens with past historical kind of companies kind of tricking investors. But overall, let's look at Cango. Cango, firstly, they're approving a special dividend. Cango's board of directors has approved and declared a special dividend of 50 cents per ordinary share, or $1 per American depository share. So I think going by this should be the American depository share. So they'll be paying $1 for this one, which is incredible. So if a company gives you $1, that's a physical, real dollar. It's not going to be something. They can't just give you a fictitious dollar. They've actually announced they're going to give you $1, so you do get $1. And then you've got a record date of the 25th of May. So if you own the stock at the end of 25th of May, you'll be recorded and you will be paid $1 per share, which is quite incredible. And the payment will happen on June the 15th, 2022. That basically clears it all up. You get $1 per share, which is pretty amazing. And not on top of that, you also get a return through a repurchasing program. So they've announced a repurchase program of $50 million. So they're going to come onto the market and buy the shares because they think those shares are too cheap, and they want to buy them because they think it's a better spend on their money to do that. So they're going to pay you $1, and also they're going to buy back stock, which means your stocks are going to be more valuable as well because there's going to be less shares on the market. For a company that's $344 million, for them to buy back 50%, that's a really great return on that. So let me just quickly do that math. That's a 14.5% repurchase of the current company on the 344 million share price, on the 344 million market valuation, which is that's a massive return. And then that's on top of the fact that they had an existing program where they announced on August the 19th that they already had another 50 million worth. So these guys have already been buying back shares. Last year they spent $23 million of their 50 million, and they said this program will still stay in effect. So not only do they have a new 50 million, they have a 27 million left on the existing program. So that's an extreme amount of buybacks that they can do if they really wanted to. The big question of why they haven't been buying more, if like why announce a new one when you still have so much left on your old one? But yeah, I know I cannot explain it entirely, but they could just be like, hey, we can do it, so why don't we do it? So in terms of the actual assets of the company, like they've made the announcement that they're going to do these things. So do they actually have the cash to back it? Well, cash and cash equivalents are $225 million. So they do have a heck of a lot of cash in the bank, and 9.6 million in restricted cash. They have short-term investments of $400 million. So you get it. The company's basically flush with cash. But the big question is there basically debts? How's their debts? So current debts are 90 million, long-term debts are $147 million. But this is a company that specializes in vehicle financing, which vehicle financing hasn't been doing too badly. But this is covered by basically the finance lease receivables of 221 million. So overall, this company does have basically 600 million they could just spend on anything they want, which kind of feels weird because it's like, why don't they just buy the whole company back with their own cash? Because they have so much cash, like 600 million, whereas the company is just worth 344 million. So that kind of speaks of a really undervalued position by that sense. But we can look into things further. So, like, how has their current business been doing? So last year, for the 3 months ended, they did $166 million in revenue, and the cost was 189 million, which led to a $24 million loss. So those 3 months ending last year it wasn't too great. But this does include some share-based kind of expenses. So they'll issue stock, but they'll have to expense it. So technically, they might have their net income for net operations might be negative 24 million. But that could be a lot lower once you add in back at it the share based compensation. And if we look at the overall 12 months, they did 615 million, though costs were 619 million. So overall, they're kind of near that break-even point. They were negative 3.6 million. But if we come back down here, and you add back in the whole, share-based compensation expenses, overall, they actually end up quite positive 12 million for the whole year last year. And basically, if we here, like, this is where they had for the 3 months ending in December last year, they recognized a fair value increase of 39 million. So overall, they were still negative for that last 3 months. So which kind of speaks about why their share price is kind of quite low, because their overall business is still kind of losing money. But it seems like they've possibly done really well doing some investments, because if their short-term investments are $407 million, they've been doing a lot of other investments, and it's netted them a lot of cash. But their overall situation themselves is their main business is not really earning money. It's just their investments, which has left them a good amount of cash, and they're just going to pay it back to shareholders. Which I guess overall, the share does seem quite undervalued if we look at the aspect of they hold basically extra 600 million in cash that they may not have to use, so they can basically pay back dividends, and they're going to do a share buyback. But the question is, what have you got left after that? You've got a business that overall is close to that break-even point, which isn't too bad. So it's not too bad. It's hard to go convincingly that this is a must buy, because at the end of the day, it is still a Chinese company that faces delisting if the rules do not work in its favor, and it is a company that we go, how true are the financials, and especially if you have basically a booming vehicle market in China. Should we be seeing more improvements for this company as well? why they're not profitable in this current situation. Like overall they are, if we actually consider that the share-based compensation was they were actually positive 12 million. So overall, that's not too bad. Like overall they're kind of positive, they're in the profits. But yeah, I think like overall for the whole year they're actually profitable. So like when you chuck a bunch of numbers in front of me, I do take time to digest it all. But yeah, overall, okay, they're positive in their investments. So it's not too bad. Worth buying a little bit if you think that the company's worth a value play, because they are paying back a good dividend, and they're basically they're basically just giving you a lot of cash back through dividends and repurchases. Who doesn't like some extra cash, I guess, especially if you're a investor who is investing for cash dividends. So let me know what your thoughts are. Do you think this is worth it or not? Until then, good luck investing, everyone.